This is a fantastically important subject to us, but I also think it's going to become more and more and more important to all of you and to the whole industry for ways that you might not expect. So we're very much looking forward to this discussion, and we've got a couple of great perspectives on this. We will try to keep to the subject matter that you read about on the website of what we're going to discuss here, but it's a very interesting subject for a number of reasons. The whole business of sustainability, and here in the United States, the word ESG, which was in vogue, and particularly in vogue in the investment industry, seems to be having a transformation into other nomenclature because of somewhat of a backlash against ESG. Having said that, it's never been more important, and it's a legally dictated reporting requirement in Europe and increasingly here in the United States and elsewhere. And companies that don't pay attention to sustainability measures do so at their peril, because there are significant benefits to doing so, let alone the required aspects of that. Cost of capital is lower for good performers in sustainability. Liquidity for public companies and valuation are adversely impacted by poor performance. Passing muster in M&A, there's a lot of reasons to optimize good sustainability practices in the business, let alone all of the important things that come with being just a good corporate citizen. So in the session today, really looking forward to exploring this, and we have two of the very best people that you could imagine to unpack this for us. To my left, I introduce you to Chad from Beynon, from Macquarie, and to Chad's left, I introduce you to Steve Myers from Praxis. Gentlemen, looking forward to the session. Chad, why don't you go first? I think you have a presentation for us, and as does Steve, and then that'll ensue a discussion.
Sure, thanks, Robert. Appreciate it. Chad Beynon, I'm a stock analyst. I'm at Macquarie, global investment bank and PE company. I've been covering the casino names for 20 years. I also do work on the hotel and movie theater names. So currently I cover over 20 publicly traded stocks here in the U.S., everything from DraftKings, MGM, Caesars, Penn, on the B2C side. And then on the B2B side, I do work with Genius, Gambling.com, GAN, et cetera. So I have public stock ratings and price targets. So to Robert's point, we have to factor in cost of capital, valuation multiples to get to our price targets. And I wanted to run through a couple slides just to kind of hit on that. One of the things that Macquarie started with probably about 5 years ago is implementing ESG work into our research. So as I mentioned, we're a global investment bank. We have research in Asia and Australia, and then here in the US. Asia and Australia are our two biggest markets, and we have ESG analysts in those offices, and every single report that's published from our stock analyst includes an ESG score. So this is something that we felt like we needed to be ahead of the curve. As Robert touched on, it's an evolution here in terms of the score. So here you can see, this is in one of our reports for Sands China. You can see essentially what goes into the ESG there. And then on the next slide, probably hard to see, but here's a scorecard. Now, this scorecard probably looks a lot like what we're seeing from some of the bigger groups that are coming out with standards. So it includes, a dozen items that each company is trying to achieve. Obviously, on the environmental side, it's all about climate, sustainability, water, energy, et cetera. On the social side, things that the last panel talked about. What are your responsible gambling measures? What are your DEI initiatives? And then on the governance side, I guess that's where the DEI, the diversity of the board, how management is compensated, if they have internal ESG measures as well. So this is something that Macquarie started to implement a couple years ago, and it is continuing to evolve. Here's a chart that came out of my ESG analyst report in Australia. She just published a post, I guess, Q4 report that included every piece of research from our Australian analysts. It was over 100 pages, and it essentially had a scorecard and goals around these companies. Australia is a key market in terms of net zero initiatives. Working for an Australia bank, we are a huge company within that space in terms of critical minerals and renewables, and we have a 2040 net zero goal here. And that's not lip service. It's something internally we talk about on a weekly, monthly, quarterly basis, and it's certainly something that's big in Australia. As we bring it back to the U.S., we did a little work in the past couple weeks preparing for this panel, just in terms of the ESG mentions. So we're on all these publicly available conference calls around earnings, and what we learned was in the space that we cover, ESG comments were up about 300% since 2010. And also in about 50% of the earnings calls, so whether it's MGM, Boyd, Caesars, DraftKings, FanDuel, they're going to mention ESG. They're going to mention their goals. Usually we think about the four major themes from our gaming companies as sustainability, diversity, equity, inclusion, community. That's probably the biggest thing that's kind of taken a focus now in terms of helping out that market, and then responsible gaming. So that is it for my slides, and we'll get into some of the other things after Steve's.
That's great. Thank you so much, Chad. And Steve, over to you. And full disclosure, Steve and I are colleagues in an initiative addressed at this very problem and opportunity for the industry called Fintel Sustain. So Steve, take it away.
If I can get this on. Here we go. I want to go back on there. Okay. My name's Steve Myers. I've been in the gambling industry for over 20 years. 13 of those I was managing director Genting for the EMEA region. Set up my own company called Praxis, consulting and advisory. Get involved in all sorts of things from operational issues through more and more to ESG, and advise a couple of public affairs companies in terms of reputation management relative to the gaming industry. As Robert said, about just over a year ago, we were here in New York and really started talking about how to unlock value in terms of ESG and sustainability and what that could mean for the industry. So we built data around 20 of the top gaming companies, and about 3,500 inputs later, we came up with a model, and it was interesting to start to see different things that came about and the trends we started to see in the industry. Obviously, gambling as a sin stock has parallels with a number of industries, primarily, I think, alcohol. But the way they approach their sustainability, I would suggest at the moment, is embryonic in the gambling company terms, but compared with alcohol. So, for example, if you take Diageo, you take LVMH, you take Heineken, all those people, they report on a pretty consistent and coherent set of data, and that's not true at all in terms of the gambling companies. So, and I think also this consistency coincides with a lack of transparency in their reporting. Quite often the data's out there, but they're just not very willing, gambling companies are not very willing to actually share it. So one of the other things we've seen as part of the trends is environmental issues tend to be at the forefront of everything. So you've got a situation where some companies, you might look through the sustainability report and you've got 20 pages on environmental, and I'm not decrying the environmental piece, it's important, but when it's combined with, say, half a page of responsible gambling for a gaming company, then it becomes much more unbalanced and just not right, because the risk base is always around the RG piece typically. One of the other things was, I used to work in land-based, but I do most of my work in iGaming now. But there is generally a better reporting piece from the land-based companies at some of this, and I don't know whether that's because they've had to do it more either state by state to their regulator, but they're certainly better at reporting in general terms. The reluctance to share data is actually stuff that's already out there in filings or public reports that anyone can get their hands on. So not quite sure why that exists, but trying to get some consistency of reporting across the sector has been difficult, and why we've used open source data to try and crunch those numbers and look at the trends coming out of it. So whilst the information's there, we need a better presentation of it. The European perspective, I think, is important to look at. Europe, I think, overall has been ahead for a while, and the fact that sustainability and ESG have been at the forefront of minds there for a little longer. In fact, people will have heard of the Corporate Sustainability Reporting Directive that people are fully on with now, and that's focused the minds of many of the larger companies who are the first to do it. And the interesting thing is it's not just environmental requirements. They're looking at treatment of employees, diversity on company boards, anti-corruption, AML, all that kind of stuff. But the interesting thing to get away from this perception of greenwashing, all these disclosures need to be third-party audited, and they need to be publicly registered, so anyone will be able to look at that. So the intention of it is there's more transparency, so anyone in the gaming ecosystem can look at that, and investors, shareholders, the general public, consumers, responsible gambling professionals will all have access to that information. So I think overall it's probably a positive thing, despite what some people are saying, in the fact that at least it will get those operators all on the same page. And then if we look at the different data sets, I think gambling is slightly unique. It has some unique issues, particularly around RG and compliance. When you look at other sectors, there's not the same coverage in the press, this general distrust that exists necessarily. But one of the things we found with the data is there are certain shortcomings, there's lack of transparency. So you need a more bespoke data set when you're looking at gambling, and the previous panel spoke about some of the issues and some of the ways they look at it. Consistency is one of the main themes, but it's particularly important to look post regulatory settlements, for example. Has a company got a second settlement, and what's the effect of that been? We've seen with some of the bigger companies, once that's happened, they've completely changed their process and procedures and are much better at measuring and setting targets and reporting on those targets as they move forward, which is important. And then, as I said, the environmental piece is important, but the social and the governance piece are always the ones that come to bite the gaming companies. You don't see the headline that a company used 10% more CO2 emissions than the previous year. Just doesn't happen. It's all about responsible gambling, the effects of regulatory settlements, how people have marketed people to people who've self-excluded and stuff like that. And then I think we'll see more and more as you look at the risk profile with this. M&A performance is a particular area where there's been some trends, and the fact that particularly if companies have not embedded their own platform into the company they've acquired, we've seen things like, they've run parallel systems for a period of time, or the JV. That's inherently more risky, and some skeletons may come out of the cupboard 18 months down the line, and we've seen some recent court cases with that kind of stuff. So moving away from just a general data set to a more bespoke data set, we think is important, and really gives people like Chad, I suppose, and others in this room a good opportunity to look at, how to unlock value in some of these companies, and plays back into Robert's point at the start in terms of how can we add the value proposition in terms of cheaper cost of capital, better capital allocation, etc.
Well, that's great. So we've learned a lot already. I mean, we've looked at the the state of play, Steve, and a great sort of outline of where the industry is in terms of reporting on sustainability and, and the status quo and where to go. And then, of course, Chad mentioned that the mention of ESG or sustainability has exploded on the part of, his work, which means that it's focused on investors. So, for all of us assembled, there's hundreds of millions of dollars on the line here that we're talking about over the next little while. Chad, maybe you could kick off and give us an outline of, how are investors thinking about sustainability and ESG, and how does that sort of impact what we're talking about today?
Sure. When we talk to investors, I think, the opportunity for a higher valuation and a higher market cap, a lot of time that sits in the question of how many pools of people can invest in a name or a sector, right? You look at DraftKings last year, it was up 200%, up another 30% this year. Simplistically, there were more buyers than sellers. Now, why were there more buyers? Because the company was growing at a certain growth rate, so software investors and internet investors were taking a look at it. As I bring that back to ESG, if there's an ESG analyst at a fund, whether it's a long only, a hedge fund, a sovereign wealth fund, an asset manager, we want to make sure that a certain company, a lot of the work that you guys are doing, is permitted to be purchased, or a certain sector is permitted to be purchased. A lot of times when we talk to certain funds, they say, I can't own Wynn or Las Vegas Sands because it makes money in China. And right now, we're not buying anything that has exposure to China. I can't buy, DraftKings because it's a sin stock. So I think as you have more of these ESG standards, which are written from, this European code, which is just launching right now that you have new KPIs, new metrics, I think that could actually bring some of these gaming names onto the screens of investors. The last part of this is, has it mattered so far? I don't think it has. We did some work in terms of valuation of these companies that had very strong ESG scores, whether they were subjective or objectively scored, and it doesn't appear to have mattered. I think, if you're looking at basket of funds, it's essentially just like eliminating energy in some of these companies that can't meet environmental standards, right? So the performance of these indices that have been ESG friendly, it's really just eliminating some sectors. But I see
that changing going forward?
I do. I think a lot of it starts within the company if it really matters for that company to hit some of these goals. We just had our year-end reviews. 50% is the what, right? What did you do? How many calls did you make? How many reports did you write, et cetera? 50% is the how. 5 years ago, that wasn't the case, right? 80%, maybe 90% of how we were compensated, rated, reviewed was just on how much business we brought in. Now, even at my company, so much is on the how, and I think companies are moving that way. So if you're empowering and hiring people that care about that, I think that'll kind of go into the social fabric of the company, and then that'll beget investors to really believe that these companies are ESG friendly.
So Steve was talking about the alcohol sector and how they do super well at sustainability reporting, and they're the beneficiaries of better capital allocations from investors. So that perhaps is a North Star for the gaming industry to think about. What are the LVMHs and the Diageos doing that the gaming industry, both at a company level and at a broader level as an industry, what can the industry do to make a better place for itself? Steve?
I think it's important to say, in terms of when you look at alcohol versus gaming, the journey they've been on has been over 20 years now to get where they are. iGaming is only just over 20 years old in reality, so there's probably a reason why gaming is behind. But what they do, they've embraced some of the things that gaming talks about but doesn't get a uniform approach to. So, for example, Sustainable Development Goals from the UN, working with the UN, so there's a consistent theme on things like drink driving, reducing drink driving, zero alcohol products, reducing alcohol dependency, and working closely with agencies in each of the countries they operate. and taking this forward and not being afraid of it, but embracing it and publicising it, but all hitting those core KPIs with regards to it. Gaming, some people do it better than others, and some people say, oh, we're the best at RG, but then when you scratch the surface, there's nothing there to measure. So it's about partly setting goals, partly talking about methodology, and partly about continuous measurement of that if you're going to actually deliver. And people like Chad will look at these things moving forward because they've got the directive from above in their own companies that's driving this, and that's going to filter its way through. It's just as we're seeing at the moment, the gaming operators who are getting pressurised by the regulators, they're pushing it onto their supply chain as well. So I think that's important. And the other thing I would say is that there is a difference currently between the EU area and the US. The EU gambling has taken this very negative connotation. And interestingly, I see in the US, particularly with all the advertising that's going on, a friend over here said to me he was sat down to watch some gambling adverts the other night, but was rudely interrupted by the news. You sort of understand where we're coming from with that. I think that things like that are going to start creating more of a narrative around the whole gambling industry.
Interesting. So, what we're talking about here, Steve, is a data set particular to the regulated gaming sector that caters to its intricacies and its particular aspects, just as other sectors may have that. There's a lot of ratings agencies and other data sets out there. Chad, as an equity analyst, maybe you could describe to us how important are all these external data sets, and how do you synthesize your own equity research function with all the data and noise that's out there in order to get a proper picture of sustainability?
Yeah, I think the cost of capital piece that you mentioned earlier, I think that's critical. If the rating agencies, allow for lower bonds or notes, which we've kind of seen, we saw a couple years ago when a lot of these green bonds were being financed here. I think that would be obviously an input into the valuations of these companies, right? Lower interest expense. If you can be a couple hundred basis points below other companies in your space, that gives you an advantage to run the company maybe a little differently than you would have. Valuations and kind of what goes into that methodology, it's very subjective. So, a lot of times we think about growth companies trading at a certain multiple, value companies trading at another multiple. I think this will be something that will go into research going forward. As I mentioned, we've been very diligent about putting it into our Australian research because it matters a lot more. I would say Canada is another region where it's so resource focused that's another market where it should be a bigger component in terms of valuation of these companies, how they're actually mining some of the minerals and those types of things. But yeah, this will be something going forward that matters. Right now, it's kind of an everything, everywhere, all at once approach where companies are just trying to tick those boxes. They're putting the presentations online. As I mentioned, Sands, that was one of the first companies. I mean, they had a 30-page presentation online, and it kind of came out of nowhere. And then every other company said, oh, wow, we're not doing this. Ahead of this conference, I actually put out a small piece of research, and one of the companies got back to me and said, can we talk? Because we haven't done anything. And it's a publicly traded company. Keep them nameless. But these are things that you have to do right now to talk to investors.
Very interesting. So in the room we have, regulators, we have compliance people, we have a lot of private companies. Maybe we can do justice to that a little bit. Steve, why should private companies be thinking about this now? Why is this important when you're not a public company, when you're perhaps a smaller private entity?
Well, I think, you will see an increasing investor conscience appear over the next few years where, you've seen it already with some of the things the younger generation. My kids don't want to buy new clothes all the time. They want to go to Vinted or wherever, all this stuff. You see, and they also want to work for companies that have the same values as them. So there's more peer pressure that will come to bear with regards to all of this. And I think it's also important, whether you're a private company that is looking for capital, you're looking to IPO, you're looking to be bought, you need to present yourselves in the best way possible and be accountable to companies. So if you're going to be acquired, and there's a whole bunch of companies being looked over at the moment, it will become more and more important, because some of the issues, you look at some of the big players in the market, top 5 or 6 companies that have been acquisitive over the last few years, a number of their problems in terms of regulatory settlements have been driven by acquisitions they've made over that time, and they've not carried out the same amount of due diligence they were able to. Now, some of it may not have been able to be uncovered, but the fact is, I think it will take a whole new level of investigation through that due diligence process.
So get ahead of it and be aware.
Yeah.
And there's an incredible congruency between the compliance function and what we're talking about here in sustainability. Sustainability is moving towards the finance function in terms of its administration, and compliance is focused on the regulatory side. And I'm sure there's many views on that, but that bridge is coming together, and it'll be fascinating to see how that works. Chad, any comments on that, on the private company and the points that Steve made?
Sure. A very recent case study was Jackpocket, acquired a couple weeks ago from DraftKings for $750 million. They did their first Series A, I think, at $50 million, and it was kind of a bootstrap company. However, they did everything right along the way with the regulators. And I think that was something that the CEO, he made a point in every stage of the company that they weren't disrupting the lottery industry. They were actually working alongside the lottery industry, calling up the regulators, making sure everything that they were doing wouldn't cause any type of lawsuit or any type of grief. So I think that was a really good case of a company that was doing it the right way, being acquired by another company that wanted to get into that space at a very high valuation. So yeah, I think that's great advice for private companies to do it right.
That's a great example. Do we have any more time? We have another couple minutes? We got to wrap? Okay, I didn't get the hook yet, but I appreciate that.
Yeah.
So any last points to make or wrap up from anybody before we move on to the next thing?
Perhaps it's an opportunity for the compliance person to be the hero for change in the company.
Okay. Chad, last word to you.
I would say, corporate sustainability officers have risen for public companies from like 9%. Now we're up to 35%. That's going to continue to move up. To Stephen's point in terms of his kids looking for jobs, we see that every day in interviews. People want to work for companies that live by this. So it's not just something to get a higher valuation. It's actually how you build a business right now. So I think that's important.
Fantastic.
Yep.
Thank you both very much. Thank you all for listening to us.
Thanks.